Hello, welcome back. Zoya podcast producer here. This week we are joined by Reask, who offer models to support the assessment of natural catastrophe risk globally. In this episode, we'll be diving into a fascinating discussion on hurricanes, climate signals, and how technology is reshaping risk assessment. Joining Matthew from Reask is CEO Jamie and Ian, a recent addition to the team with a PhD in energy and resources from Berkeley. If you're curious about how physics-based modelling can drive smarter decisions in a rapidly changing world, this episode's for you. We're also gearing up for Exponential Risk London this March, which Reask are kindly sponsoring. You won't want to miss it. Now let's get into the conversation.
Jamie, Ian, it's great to be talking to you. A topic very close to my heart, hurricane activity, climate, and all things connected, as we're going to come and talking about. But it's a truly global podcast today. Ian, you are in Tahoe, which is a lovely part of the world. Have you got snow yet?
We do have snow. Yeah, we had a nice early season. So it's been a lovely little dusting of snow, and now it's going to be sunny for a little while, as is fairly typical in California here.
And Jamie, what about Zurich? What's happening over there just now?
We had a bit of a big dump a week and a half ago. I measured it with a ruler, 25 centimeters. It's all gone now.
They get bigger numbers measuring in centimeters over there, though. So
it's a whole different discussion. Well, look, it's great to be talking about what you're doing at Reask. So just a bit of an overview, first of all. Tell me how I've done, but our digital intern Iris is basically now trawling through our website to find out what it knows about Reask, and this is what it told us. So Reask offers models to support the assessment of natural catastrophe risk globally. Tools can be used independently or to enhance other third-party catastrophe models. Key offerings include guidance for seasonal forecasting of tropical cyclones, real-time event response capabilities, integrating climate signals into catastrophe modeling to better understand risks in a changing climate, and an approach that allows for the creation of multiple views of risk for events like hurricanes, enhancing the accuracy of risk assessments. Well, I thought that was pretty good, but we've done quite a lot with you, so there's quite a lot to draw upon. Jamie, anything in there that we've missed that's really important to think about with Reask?
I think your marketing intern has nailed it. We might have to take some of that for some of our overviews.
Well, it's our digital marketing intern, so you're welcome.
Digital marketing, yeah.
Yeah, borrow some of that. So Jamie, you're the CEO. You started off your life in modelling. You worked in capital markets. Ian, you've also come out of capital markets. You've got a PhD from Berkeley in extreme events, and you've been at Reask since January. So what is it that sort of, I guess, attracted you to Reask, and what have they got you doing?
Reask has kind of a very clear vision of how they can improve upon existing tools that are already used by the industry. I think when it comes to broader extreme events risk and climate risk in particular, I think we're all kind of like figuring out what industries can incorporate this information in which ways. And insurance is kind of a clear case where insurers and reinsurers and everyone in the industry has a very clear incentive to understand not just future risk, but even understand today's risk and how that's changed from the past. Since I've joined, I've kind of been focused on essentially everything that happens after the hazard modeling. So that's kind of building vulnerability curves, which I know we'll talk about in a little bit. That's generally assessing how do we translate this physical hazard, so hurricane winds and flooding, et cetera, into actual impacts. So whether that's dollar values or displaced population or health impacts, et cetera.
Jamie, I want to come to you, just picking up a little bit on what Ian talked about there. And the great thing about what you're doing is it's a win-win in terms of you're adding more insights and information. Ultimately, everybody should benefit from that. The insurers, the brokers, the insureds, the community at large, of course. But I think a little bit about what you're doing in Reask, and I don't think this analogy is quite right, but it seems to work for me. Someone buys a car and they kind of want to then put on some aftermarket goods or beef up the engine. Your car's still your car, but you can do more things with it. And to a certain extent, this is a rather crude analogy, but I think the important point here, as Ian said, is you're not trying to replace the traditional catastrophe models, but you're actually adding this on. So now that you've got the tool and you've also got people these days who are increasingly hiring people that could build the models themselves, some very smart people with PhDs in their staffs. How does this all work in practice now with the clients you're working with?
Yeah, I guess it's been a little bit of a journey for us as well, because as you know, large part of the founding team, myself, even Ian has a background in catastrophe modeling. We all come from the sector. So we used to build cat models. We know how they work. We have the view that cat models do a very, very good job. And they do a very good job of defining a benchmark view of risk for the industry. They're almost the currency of transacting risk across the entire insurance value chain. But we've got these benchmark views. How can we do a better job of incorporating some more dynamic features of the climate into the old technologies that we used to build? So actually, a lot of our journey was first task. So we kind of started out as an academic company saying, okay, we can build these methodologies, these new tools to add these new features that we know aren't necessarily incorporated as robustly into cat models. There's maybe 3 or 4 years of developing that. We were fortunate to have, as you say, some very, very smart early adopters. And then what Ian's talking about came into play, which was how can we use this stuff? And the use cases, once we had the technology, started to emerge themselves with our sophisticated partners. Like you say, a lot of insurers, reinsurers have smart teams. They hire PhDs, give them access to a data set, which is new. We didn't know exactly how it could be used, but we knew there was value in there. And so we spent probably the large part of the last 2 or 3 years working with, some very sophisticated early adopters to do exactly that. And then we found that there's huge demand for understanding these, I could call them gaps in cat models, especially as the climate changes so dynamically. People are asking these questions. Analysts, people always use this word best estimate. Actuaries use loss pick. At the end of the day, we're in the game of saying, what's the most accurate view that I could have for the claims that I need to pay next year? We come in at giving analysts a data set that allows them to come up with the best estimate of that risk. It could be in the short term. A lot of it is in the short term, but the flexibility of the model means that we can do any term, historical, current, future. But it's all around, can I get a best estimate for the claims that I think I'm going to pay? And from that, you can build your view of price and your view of portfolio construction, your view of diversification, your view of capital allocation. And all of a sudden, from having this model, we bolt onto all of these different areas of financial impact across the entire value chain.
And let's come back to that point about the different time horizons. Ian, might be one for you. So people talk about climate variability, climate change quite loosely and not always informed by the sort of background variability that we get with cyclones, hurricanes. Yeah, can you just sort of explain for people that may not be familiar, what is the distinction between longer term climate impacts on cyclones and then some of the short term, and by short term I mean sort of week by week as you see going through the hurricane season? How should people think about the differences, and what choices do they now have to take account of those differences?
It's a good question. I think I usually think of these things as we have some natural variability in our tropical cyclone risk, but in any weather patterns, right? One year is never the same as the next. And so some things that affect tropical cyclone activity, in particular when we're talking about hurricanes, which are tropical cyclones in the Atlantic and affecting kind of the east coast of the US and the Gulf, we think about El Nino as one of the stronger signals. So El Nino is switching back and forth from the El Nino side to the La Nina side over the course of years, and that's affecting the frequency and severity of storms that we experience here in the US and also in the Pacific as well. So that's kind of a background occurrence that is happening. And now we're layering on the human-caused or the anthropogenic climate change portion of that. So we're getting warmer air temperatures, but also kind of crucial for what we do, we're getting warmer sea surface temperatures as well, which provides more energy for these storms. And in general, we're getting the at least the possibility of generating more severe storms. There's a variety of other kind of signals that climate change brings, but the broad sense is that we have this background change year to year, month to month, week to week even, that's going to be there regardless of whether there's a climate change signal or not. And the way we often think about our products is that we have to be able to understand that change and to be able to predict the present risk before we start talking to anybody about the future. So it's great to do a stress test for how your portfolio's risk might change by 2050, considering different climate scenarios. And a lot of people are interested in that. That's kind of been the traditional approach to like climate risk or climate scenario analysis. But before you can get a credible model that can predict the future, which is always going to be more uncertain than the present, we need to be able to reflect that natural variability And we need to be able to reflect today's risk and how that differs from 20, 30, 40 years ago. And so that's where we found kind of, most insurance policies are written on annual bases, and they're not necessarily going to go straight to what's the risk 30 years from now. That's not going to necessarily be the first kind of point of contact. So we try and do the best job of understanding how risk has changed to date, and it really has over the past century. And then once we validated that, we can start to talk about how does the kind of growing climate signal in the coming years further change that risk.
And you mentioned the word anthropogenic in there, if I pronounced that correctly. Ian, you'll need to explain to me anyway what that means.
Human caused. So, and that's the greenhouse gas emissions causing warming of the atmosphere, warming of the oceans. Basically, any sort of fingerprint that you can tie to the greenhouse gas emissions that we've kind of continued emitting post industrial revolution.
Brilliant. Well, I've definitely learned one thing today that I didn't know before. So thank you for that. And Jamie, I just want to come back to you because you talk a lot at Reask about a globally connected cyclone model. Can you explain what that means in practice, or what it means relative to what would be available elsewhere or otherwise?
Yeah, again, this was related back to the start of Reask, where obviously traditional models are built in isolation, different regions are built independently. But since climate is a globally connected system, and these signals that Ian is talking about, they affect the global behavior, characteristics, activity of tropical cyclones. So if you really want to understand how these events are connected within a global sense, you have to have a model that connects the globe. And so that was one of the first things that the team did, was to say, okay, can we look at these climate signals on a global basis and then say, okay, if the climate is in a certain state, what does that mean for activity in Japan? What does that mean for activity in the US? What does it mean for activity in Australia? And if you're tying that to the same climate, you can then say, do they all go up together? Do they all go down together? Do some go up and some go down? And that is exactly diversification benefit, or could be the opposite. It could be fully correlated.
I was just going to say a key point to kind of build off that and to emphasize on Jamie's answer there is that we built a model that learns the broader physics of what's driving these year-to-year fluctuations in hurricane activity, rather than looking at each individual location on a coastline, seeing how many times that location was hit in the past 30, 50, 100 years, and kind of calibrating a model to that number, because the risk today may not be the same as the average rate of landfall over the past 100 years, because we are living in this dynamic climate that, again, is changing not just on a year-to-year basis, but also with this longer-term trend of this anthropogenic or human-caused climate change. So I think the key contribution there is that we started from a model that can learn the background physics, and that kind of like naturally allows us to understand how one basin is correlated to another basin. So if you have a portfolio with assets in the West Pacific and in the Atlantic coast of the US, traditionally you might have some like risk views for each of those, and you could sort of build in your view of how these are correlated, because you want to know, in a bad year in the Atlantic, are you going to have a bad year in the Pacific, or are you going to have a good year, and is that diversification going to balance out? So folks can kind of build in these views on how they're correlated. But what Reask's approach does is it kind of provides that natively, because the underlying engine that's kind of building these stochastic simulations of events is doing so with an understanding of the physics of the climate that is occurring in a given year. So certain climate patterns will cause those risks to go up in parallel, or sometimes will cause one to go up and one to go down. And that's important when you have a spatially, globally diverse portfolio to understand.
And Jamie, with the clients you've got, generally they're more demanding, but it's probably not quite the right term. But they're certainly the more they're thoughtful about this. What do you do to help them believe in what you're building and to validate the Reask view?
Yeah, they are demanding, but maybe not demanding of us in that sense, but they are demanding on the robustness of the data sets and the best estimates that they're producing. And with that, you need to build an awful amount of trust and credibility. And the way that our event set and the way that we build footprints has fundamentally been built is that it opens up the door for people to test it. Our stochastic event set is physically based. So you could say, okay, if I want to believe the Reask event set, does it reproduce the historical statistics of what I've observed in terms of US hurricane activity and landfall risk? With our events, we've generated over 2,000 historical tropical cyclones. So we open up the door for this next level of credibility, which is really using, people have to be careful because, history is not a good benchmark for determining what's going to happen in the future. But history is very, very good at validating. And if you don't have a model that reproduces history, how can you say that your model's any good? And as Ian said earlier, we can't even think about predicting the future, which is inherently uncertain, unless we can validate and build credibility and trust that we can do the last 40 years, 50 years, have a view of today that makes sense relative to these physical elements that are driving the model. And then practitioners can go a layer further and they can say, well, why is the Reask model going up in risk? Is it just a statistical signal in the model? We say, well, if you look at the climate that forced that model, the sea surface temperatures might be warmer in that region. So therefore you had more hurricanes. Or you might say, when I forced it with a certain climate, I had more risk in the Northeast than I did in Florida. And there could be some climate signal that's forcing those hurricanes to move further north. And you can relate that signal that you're seeing in the simulation to a real physical variable. So it's all about building that trust, credibility, and understanding with the event set. And once practitioners have that, they start to build value in extracting views of risk once they've built that credible view.
Yeah, I was going to just add one key way that we do that is just through transparency and through publishing our methods through a peer review process, in addition to, providing documentation for our clients, et cetera. And so I've come to find, working with the insurance industry now for a short period of time, that some people tend to have very strong views about what hurricane risk should look like. And so the best we can do is kind of provide them our view, but also tell them how it's created, point them to, again, peer-reviewed sources. Not everybody's going to buy it. Sometimes people are going to have their own strong views that look different than what we're providing and are just not going to do it. But the best we can do is provide that layer of transparency. And especially there's some cases where our view of risk doesn't necessarily line up in a individual location with the observations that we've seen in the past 100 years. And that's expected. Not everywhere, these are rare events. So not everywhere where we expect the average landfall rate to be 1 in 20 years, do we get 1 every 20 years? And actually, Hurricane Helene was an example, that Big Bend region in Northwest Florida, where before the last few years, we'd had a pretty long drought of hurricane activity there. And so if you were purely basing your model on statistical frequencies, you might see a low risk there. And that was an area where the Reask model was traditionally higher than you might expect otherwise. And over the past few years, we've kind of seen a bounce to the other side, where we've seen kind of greater amount of activity there, especially kind of in the area where Helene landed. So there's areas where it's never going to match up perfectly, but we provide the validation exercises and we kind of provide as much transparency as we can.
And we talked quite a lot about hurricane frequency, severity, but what about vulnerability, the impact that a hurricane of a certain wind speed can make on the physical infrastructure and the buildings? How are you sort of complementing what people have got already with vulnerability?
Yeah, it's a good question. And I would also add the exposure piece in there. So a lot of times people think about risk as the hazard, which is the physical part that we've been talking about so far. The exposure, which is, how many people or assets or whatever you might care about is in the way of that event. And then finally, the vulnerability, which is how do they respond to certain levels of wind, certain levels of flooding, et cetera. And so those are all really key pieces in the risk part. And that's largely kind of my role here at Reask, is to take all the great work that folks have done on the hazard side and help to expand how we can use pieces of that exposure and vulnerability modeling to make our hazard data products more usable and more useful in different contexts. So we don't at the moment provide vulnerability curves for the insurance industry. That's kind of the domain of traditional CAT models, and we provide tools to augment those views of risk and vulnerability using our hazard sets. So we try and essentially allow people to adjust a traditional view of risk to different dynamic climates. And then over the long term, we are working on the vulnerability piece. But one thing I would note is that vulnerability is not, the way we think about it is not just in the insurance industry and is not just with respect to insured loss. So you can think about vulnerability for any impact you care about. For example, we have a partnership currently and hopefully a piece that's coming out soon on how you can predict the spike in emergency calls in different regions as a function of hurricane wind speed. So that's an example of a quote unquote vulnerability curve that is not the traditional insured loss sense, but is still really relevant to different industries, and in this case, to kind of disaster preparedness and emergency response. And so what we can do, because we have a kind of uniform modeling engine for historical events and for future events and for real-time forecasts, we can look at this catalog of historical events. You can bring your own data. So you have it, in this case, it was data on emergency call responses, and we can pair that up with our hazard maps and then build these vulnerability curves empirically. So that was a lot, but in general, we're building out that portion of our offerings to generally make the hazard data more useful in more contexts.
And we've seen that. I guess it's hugely beneficial for us as a startup that's scaling, because we do have this deep technology where it was very much a science-led development. But then because we have this complete global data set of high resolution wind speeds at 1 kilometer and validated in peer-reviewed journals, validates pretty well against observations, you start to observe this unseen value that Ian mentions. Once you start joining our data set with other data sets, you start to see new correlations, or you start to see things that you didn't necessarily know were there or you couldn't explain. But that's really down to just going deep on the hazard first. So again, not thinking about cat modeling exposure vulnerability. It's okay, can we do a really good job on the hazard, both at individual event level and then in a globally connected way with these stochastic event sets? And I guess the secret is in the name Reask. And say, okay, can we Reask how catastrophe models are built? And if you want to really do that, you have to go back down to the hazard. So that's really been the driving force of the business from the beginning. And now we're seeing this whole world open up because we have this data set that you can start looking at, and people like Ian can go in and start looking at these correlations. Oh, this makes sense now. And then we can start adding more value to customers in quite a few different ways, which is, doesn't sound good for focus, but it does sound good for value.
So parametric insurance, you were seeing quite a lot of growth in that area. That traditionally in parametric, hurricane has been quite an opportunity to find some innovative ways to provide alternative forms of cover where it might be difficult to get it through traditional insurance. I know you're doing a little bit in that area. What have you seen been happening in the last 12 months?
Yeah, so we've been providing data to our parametric partners since 2021. And really what they are unlocking there is this global consistent view of 1 kilometer wind speeds. For us, if we're estimating the wind speeds from an event in Australia or Florida, it's all from the same model. You can believe, once you validate the model, that those estimates of wind speeds are credible. They're of a high precision. Our precision in Australia is the same as our precision in Florida. Once you've done that validation, you can say, well, actually, I believe the Reask wind speeds would be a good trigger to trigger parametric policies. So what we've seen in the last 2 to 3 years is, and parametric, I guess, is not a new thing. It's been around for a number of years in the industry. There's a number of parametric cat bonds, both in the wind space and in the earthquake space. But what our data's really allowed the industry to do is write new types of insurance policies to make them more accurate and more efficient. If you have a good estimate of a wind speed at a certain location for a very, very large risk, a hotel on the coast, significant amounts of sums insured, whether that's for business interruption or physical damage, and with the historical event set and with a probabilistic view, with our data set, you're now in a position to historically check the payouts of that location. Did it make sense from a very, very large event in history? What would that price be? What would an effective trigger be? And then when an event happens, you can use the Reask data to trigger that policy. So what we've really seen is an expansion of adoption of our data into the parametric insurance products of our partners, of which we are very fortunate to work with some of the industry leaders. And now we're seeing parametric policies be distributed on a more global view. You can now write some policies in Australia or in Fiji where the data was just not robust enough to have that accurate view of risk and a more efficient way of transferring. I mean, Cat in a Circle's been around for a long time. It's done a very good job. It's a very simple and transparent trigger. But the problem is, what happens if your island's really, really small? The storm just passes to the west or east of the island, but you have very, very significant wind speeds on the island. There you wouldn't have a payout, but you would have paid for the policy. So our data has really been used just to bring that level of accuracy and precision to the policyholder so that you can have more effective risk transfer. And because it doesn't have that broad reach of Cat in a Circle when it's at location, it actually prices pretty efficiently as well.
Well, look, we've covered an awful lot in there, and thank you for sharing that. In terms of people wanting to hear more, we'd like to be having you join us on the 4th and 5th of March for our exponential risk event in London. But Jamie or Ian, if people want us to learn a bit more about you, what's the best way to discover that?
Well, yeah, we will be at Exponential Risk, so we're always open. We've been on stage with you, Matthew, a few times at Instech as well, so I'd expect that to happen. For anyone who's interested in the papers, obviously we've put a lot of our work out across all of our data sets, whether it's the event stuff, tropical cyclone rain. The science team have another paper in waiting on the stochastic track set. I think there's some links on our website where people can download the papers and read up on our methodologies. But yeah, we've got an office in London. If anyone's in Tahoe, they can go and see Ian. But yeah, we're present at most well-known industry events. So we're always happy to discuss, or we could be presenting.
Yeah, and maybe I would just do a shameless plug for my side of the work that we do at Reask, and that if you're someone out there that has, I guess we'd say, like non-traditional risk or not necessarily insurance risk, maybe that's part of it, but maybe you may have other use cases. If you have data on outcomes from historical events, the type of analysis I talked about earlier where we were looking at those emergency calls, we're eager to partner with folks where we can bring both the historical hazard footprints for hurricane winds, hurricane rains, and flooding, as well as the kind of analytical approach to help us build that vulnerability and maybe kind of provide a lens into some of those less seen impacts of tropical cyclones. So definitely find Jamie or folks at that event, or you can always find our website and reach out. But that's one area that we're trying to make the deep kind of modeling development that has occurred on the hazard side. We're trying to make that as useful as possible in different contexts. And this is one way that we're doing that.
Jamie, Ian, that was fantastic. As I said, a lot of content in there, and again, learned a lot. So thank you very much, Ian. Enjoy the rest of your day. Jamie, enjoy the end of your day, and we'll see you face to face soon.
Sounds great. Thanks so much.
Yeah, thanks very much for hosting us, Matthew.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. If you haven't already heard, Exponential Risk London is a new 2-day conference hosted by Instech, dedicated to addressing the evolving needs of the global catastrophe and climate modelling community. Tickets are now on sale, and hopefully we'll see you in March. That's all from us this week. Goodbye.